Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this video, we'll directly compare these two ETFs, looking at historical returns, expense ratios, and which one could be right for you in 2025 and beyond. Liquidity and trading flexibility. S&P 500 ETFs trade like individual stocks on major exchanges throughout the trading day. This offers you significant liquidity and flexibility. You can buy or sell shares at any point during market hours, just as you would with Apple or Microsoft stock. This is a key difference from traditional mutual funds, which only price once a day after the market closes. This real-time pricing and continuous trading allow you to react quickly to market movements if needed, or simply buy precisely when you are ready. For everyday investors, this means great ease of access. You are not locked into specific trading windows. Simplicity and accessibility for all investors. One of the greatest beauties of S&P 500 ETFs is their simplicity. You do not need to be a financial expert to understand them. You buy a share, and you own a slice of the S&P 500. This straightforward approach makes them an ideal investment vehicle for almost anyone. Whether you are a new investor taking your first steps or an experienced one looking for core portfolio holdings, these ETFs are easy to access. Most major brokerage platforms offer them, making it simple to add them to your investment account. This ease of use, combined with their strong performance potential, makes them a pillar of many successful investment strategies. Considerations and risks of S&P 500 ETF investing. While S&P 500 ETFs offer many advantages, like instant diversification and low costs, it is important to remember that no investment is without risk. Understanding these potential downsides helps you make informed decisions and manage your expectations. Let us look at what you should consider before putting your money into these funds. Market risk and volatility. Even with broad diversification, S&P 500 ETFs are not immune to market downturns. They directly reflect the overall stock market's performance. When the economy faces challenges or investor sentiment turns negative, the value of the S&P 500 index and, by extension, your ETF, can fall sharply. Think of it this way. Your S&P 500 ETF holds a tiny piece of hundreds of companies. If most of those companies decline in value due to a recession or a major global event, your investment will also decline. This is known as systemic risk. While diversification within the S&P 500 hedges against problems in a single company, it does not protect you from broader market crashes. You should always be prepared for the possibility of volatility and temporary drops in value. Lack of active management and underperformance potential. S&P 500 ETFs are passive investments. This means they simply aim to track the performance of the S&P 500 index. They do not have a fund manager actively picking stocks or trying to beat the market. Their goal is only to match the index, not to exceed it. Historically, most actively managed funds struggled to consistently outperform broad market indexes like the S&P 500 after fees. So, while passive investing often wins in the long run, there can be specific market conditions where an expert fund manager might identify opportunities that allow them to do better than the index for a period. However, these instances are rare, and finding such a manager is challenging. With an S&P 500 ETF, you accept that you will get market returns, nothing more, nothing less. Concentration risk in top holdings. While an S&P 500 ETF gives you exposure to 500 companies, it is important to remember that the index is market capitalization weighted. This means the largest companies have a much greater impact on the index's performance than smaller ones. For example, a handful of giant tech companies often make up a significant portion of the S&P 500's total value. Consider this scenario. If the top 5 or 10 companies in the S&P 500 face significant problems, their performance can heavily influence the entire index. This creates a type of concentration risk within the diversified fund itself. Your fund is spread across many companies, but a large portion of your investment value could still be tied to the fortunes of a relatively small number of very big players. It is like having a large basket of fruit, but half the weight is from just a couple of big watermelons. If those watermelons spoil, it affects a lot of your basket. How to incorporate S&P 500 ETFs into your investment strategy. You now understand what S&P 500 ETFs are and their benefits. So, how can you effectively weave them into your personal investment strategy? These ETFs can be a powerful tool for various financial goals, from retirement savings to balancing your portfolio. Let's look at some smart ways to use them. Long-term growth and retirement planning. S&P 500 ETFs are an excellent choice for long-term wealth building. Think of them as a foundational piece of your investment puzzle, especially for retirement. These funds offer broad market exposure and have a history of delivering solid returns over many years. This makes them ideal for accounts like your individual retirement accounts, IRAs, 401ks, or even a standard brokerage account where you plan to invest for the long haul. By holding an S&P 500 ETF in these accounts, you give your money the best chance to grow with the overall market. You aren't trying to pick winning stocks. Instead, you're betting on the growth of 500 of America's largest and most successful companies. This strategy shines when you give it time, allowing compound interest to work its magic. Dollar cost averaging strategy. One of the smartest ways to invest in S&P 500 ETFs is through dollar cost averaging. This simple strategy involves investing a fixed amount of money at regular intervals. For example, you might decide to invest $100 into your S&P 500 ETF every 2 weeks or $200 every month. Why is this so effective? It helps you avoid the trap of trying to time the market. You'll buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out your purchase price. It removes emotion from investing and can lead to a lower average cost per share. This strategy reduces risk by smoothing out the ups and downs of market fluctuations. It's a consistent approach that works well for building wealth steadily. Balancing with other asset classes. While S&P 500 ETFs offer excellent diversification within U.S. large-cap stocks, a truly robust portfolio combines them with other asset classes. Your overall portfolio should match your individual risk tolerance and financial goals. Consider adding elements like these. Bonds. These can provide stability and income, especially during stock market downturns. They often act as a cushion, making your portfolio less volatile. International stocks. Investing in markets outside the U.S. adds another layer of diversification. Different global economies perform well at different times. This can capture growth opportunities that U.S. stocks might miss. Real estate, through REITs. Real estate investment trusts can offer diversification and income potential tied to property markets. Commodities. Assets like gold or oil can also play a role in certain portfolios, especially as inflation hedges. By thoughtfully combining your S&P 500 ETF holdings with these other asset classes, you create a portfolio that is more resilient. It will be better equipped to handle various market conditions while still aiming for long-term growth. Tailor your mix to fit your comfort level with risk. A younger investor might lean more heavily into stocks, while someone closer to retirement might prefer a higher bond allocation. S&P 500 ETFs stand out as a clear choice for many investors. They offer immediate diversification across 500 major U.S. companies. They also come with very low costs, which helps your money grow more over time. Plus, their straightforward nature makes them easy to understand and access, even for those new to investing. These ETFs can serve as a strong base for your investment plan, whether you are saving for retirement or balancing a broader portfolio. Always align your investing with your personal financial goals and how comfortable you are with risk. Consider talking to a financial advisor for personalized guidance. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.